We're watching the market's reaction to earnings out of Chevron and Exxon this morning. They're both slashing capex and warning this quarter could be pretty darn ugly. Stewart Glickman covers the energy space at CFRA. Stewart, thanks for joining us this morning. You are fresh off the earnings call over at Exxon. What did you learn?
So, like you said, capex has been slashed for the second. Exxon has maintained its capex cuts down 30%. Chevron accelerated its cuts to also match that. Another 30% down for Chevron. That's pretty much part and parcel of where the industry has been heading, and it's because of concerns about how long this demand destruction is going to continue.
Hey, Stewart, Chevron reiterated that its dividend is a priority. We know it's a big reason why a lot of people like to be in these big oil names. Is that the right thing they should be doing now with their money, or should they be sending a different message to Wall Street and either suspending or cutting that dividend?
So you're right that it's the one thing that Chevron is prioritizing these days, Alexis. I would say it's probably the only thing that as far as messaging to the investment community goes, growth investors fled big oil a long time ago. Prices have been mediocre for quite a long time. Anyone who's an ESG investor wants nothing to do with big oil. So what do you have left? You have income investors. And so protecting the dividend is clearly the number one priority for both companies. I think it's the way they should be focusing. If you compare dividends on the one hand versus earnings on the other hand, it doesn't look all that great, but they do have the luxury of strong balance sheets. And I think both companies are likely to tap those balance sheets to help protect the dividends.
Stewart, if you're still there, Stewart, one thing that stood out to me was that, and it brought a chuckle to me, to be honest with you. Exxon noted in their presentation this morning, the long-term fundamentals remain strong. What planet are they on? What fundamentals remain strong in the oil industry longer term?
Yeah, so it's a fair question because obviously you have inroads from substitution to renewable energy, and clearly the near-term picture doesn't look that great. I think what they're thinking about is kind of a sweet spot in the next, say, 5 to 10 years before renewable energy really has a chance to make wholesale inroads into taking away market share from fossil fuels. But after all these capex cuts finally start to catch up with supply. But you're right. I think longer term, big oil needs to diversify. Some of the other super major oils, for example, Total, have done a better job about expanding their efforts into renewable ventures. And I think Exxon and Chevron will eventually move in a bigger way in that direction.
Stewart, in terms of... Go ahead, Alexis.
About the Permian Basin, because Chevron said that production was up, was it 48% year over year? I mean, do you expect that to be sustained in this quarter and in post quarters?
Yeah, it's a good question. So Exxon's Permian production was actually up 56% year over year. But is it sustainable? No, it's not. The Permian has been really the workhorse of incremental production growth year over year for the company, and I think that's the place where you're going to see the largest cuts in capex. So that 30% capex cut that Exxon's going to be doing, had been $33 billion not so long ago, now down to $23 billion. Where are those cuts coming from? They're going to be located in the Permian Basin to a large extent.
Stewart, this quarter, what are the debt raises look like from Exxon and Chevron? Will they raise debt, and what should an investor expect to see in terms of interest rates on that debt?
Yeah, so I don't think either company's really in a position where they have to go back to the capital markets for more funding. Their liquidity is fairly strong in both cases. Net debt to cap rate ratios at the end of 2019 were in the 10%, 11% range. That's quite good compared to your typical E&P, which is more like 35%. Now, once you factor in impairment charges, and I'm still working my way through the numbers, those ratios are going to rise a little bit, but by and large, I think they're in reasonably good shape in terms of liquidity at hand if they need it.
All right, let's leave it there. Stewart Glickman, CFRA Analyst. Good to see you. Have a good weekend.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.